Hey everybody, it's Gav here from Global CRE TV, also known as GCRE. Today, as always, 10 Eastern time, we always have the Mobile Home Park show with Glenn. And today we have the benefit of having Barry Dollman from Eastern Union, a major finance brokerage house based out of New York or headquartered in New York. It's going to be a really cool conversation that we have today because today we're going to really discuss the ins and outs about how you actually go about financing this mobile home park. So in previous episodes, Glenn, I've always talked about, the different things that you want to consider, but we thought today would be really good to bring in somebody who is actually in the finance world and who could talk more about this. So with further ado, let's just add these guys to the call. Hey guys, how are you doing today?
Doing excellent.
Doing well. Morning. Thank you for having me.
We'll love to have you. Glenn, always a pleasure to be speaking with you as always.
Always.
Barry, it's a pleasure. I know today we're going to speak about, how to finance a mobile home park deal. From what I understand, you guys are specialists in this. So for the viewers who are looking straight up front, if you guys are looking for finance for a mobile home park, of course, speak to Barry, but also speak to Glenn, our go-to guy for when it comes to anything mobile home park. So, guys, without further ado, I'm going to come off air for now and let you guys run the show for the time being, and I will join you guys back towards the end.
Sounds good.
I look forward to it. Take care.
Thank you.
Well, Barry, thanks so much for joining me today. I know you got a busier schedule than even I do, so I really do appreciate you being on here with us. Thought it would be great value to have you speak a little bit since we've done some transactions now, and you guys are our go-to firm, and you do something like $5 billion a year in financing in all real estate verticals. Why don't you give a little quick background on Eastern Union and kind of segue that into some mobile home park stuff by the end?
Yeah, absolutely. So Eastern Union is a mortgage brokerage firm. We're based in New York. We have offices in New York, New Jersey, and I'm in the Maryland office. We have traditionally been doing, the major food groups of financing, office, retail, multifamily. About 4 or 5 years ago, we've got entrenched into the mobile home park space. We've found that from a financing perspective, we were always getting a lot of requests for financing mobile home parks. We would always just, move on from it. We didn't really have an avenue to place those loans. And, we kind of, put our heads together and realized that it's an underserved market from a financing standpoint. And there are a lot of borrowers out there that needed the financing. So we made a concerted effort to cultivate relationships with lenders that do lend in that space. And, over the last 4 or 5 years, we've been extremely successful in financing all aspects of mobile home parks, stabilized, value add, anything under the sun. And so, as a company as a whole, we do about $5 billion in financing, and probably in the MH space, somewhere around $200 million a year in financing.
Great, that's impressive stuff. It's that's why you guys are my go-tos on finance. Yeah. Anytime we have a deal that we're underwriting, we always go, to Eastern Union and get somebody to give us a quote on what that debt's going to look like. We know it can get to the finish line when you guys give it to us.
Yeah,
so,
and we,
in the mobile home park world.
I was just going to say we also appreciate that relationship and working with you guys, and it's been phenomenal. And we love seeing the packages that you guys put together. You guys do a phenomenal job.
Thank you. Yeah, it blends real well with working together with both of us, and you guys know this industry and know how just terribly challenging it is to get something financed. And today it's easier than ever, but it's still a bear. It's still real hard to get done. And that's kind of what we wanted to talk about here on this show. Is I've been prepping the audience over the last handful of episodes, kind of what you got to do to buy a park, and now that we're kind of all the way through a lot of that, one of the big remaining questions is, well, how do you finance this, and what kind of down payment do you typically need, and what are the different avenues of financing? And this is a value add and has park-owned homes. How does that affect it? And so we thought it would be appropriate to kind of pick your brain a little bit and understand that most of our guys watching this show are going to be on new buyer kind of list of who's purchasing a park. And most of the time it's, probably going to be a park in, $500,000 to $5 million range. And so even within that small range, there's a lot of variety out there available as to loans. So why don't we start at what what most people would prefer on their first deal, which I believe would be like a Fannie Mae type loan, and what kind of qualifications you have to have for a Fannie Mae loan?
Yeah. So we know that, and this is, probably one of the number one conversations we have with new borrowers is their dream is to get into, a Fannie, a Freddie, or a CMBS loan, something where it's longer term, longer amortization, non-recourse financing. And, what we try to educate them on is Fannie Mae is a little bit of an inside the box type of lender, which means that they have their checklist that you have to meet in order to be what's called a qualified borrower. So it very rarely, if you are a first time, park buyer, would you qualify for a Fannie loan? There would be some exceptions if you have some previous experience, maybe in multifamily, and you can use that, or if you've been in the management side of a park. But, traditionally you have to have 2 years of experience owning and operating mobile home parks before you can get your first agency loan executed. So with that being the case, it takes a lot of the first-time borrowers out of the mix for getting a Fannie or Freddie loan right out of the gate. And traditionally you have to do other avenues to get your financing in that regard.
And that's before we even talk about if the qualifies, for Fannie Mae as well. First, we got to make sure the buyer qualifies, and if they can even go down that road. And if you're a new buyer, as you were saying, it's going to be very difficult. Luckily, you guys have some other options that might be as attractive as getting a loan or preparing, getting a loan in preparation to get a better loan in a couple of years after you have the experience. So if the buyer doesn't qualify for a Fannie Mae loan, what other options does he have?
Yeah, so we see two or three main options. There are a number of community banks that are local to specific areas, and also that have a national presence that we've had tremendous success with getting borrowers loans for, especially if it's their first time acquiring and owning a park. So, what we actually have done in the past is, because we're a nationwide brokerage and we've had cultivated relationships with all these lenders on various other deals, we've actually started picking their brain and saying, hey, we're getting into the mobile home park space. What are your thoughts on it? And to our surprise, a lot of them actually, their response was, yeah, we love it. We just don't see enough of them. Or, the packages we get are not, the right quality. So what we do on our end is we try to, as best as we can, put together the package, as clearly and concisely as possible for the lenders that we're going out to. And predominantly for first-time borrowers, it's going to be, a local community bank or a credit union who's going to be, interested in doing that deal because they're local. They know that area. They understand the market and the nature behind, the mechanics and the economy in that deal, in that market. And what we do is we package it in a way where they can look at it very quickly, and within a 5-minute review of the deal, they can know
our connection here. Okay. Sorry, we cut out there for a second.
Okay. Yeah, I'm not sure where I lost you.
So you guys are helping. So you're helping that new buyer repackage what's often a poor package to make it kind of fit these community banks.
Yeah, so if it's a first-time borrower who's not, necessarily buying somebody, a park off of, a reputable brokerage firm that's putting their own OM together, a lot of the times what we see is, a handwritten rent roll or a handwritten P&L, and a lot of the times that's the initial pass from the banks. The banks will look at it and say, it's not 1975 anymore. We have Excel, we have, all these modern technology softwares that we can use to create a package in a better light. And that's really where, using somebody that has experience in the financing side really comes in, because we're able to give the lenders the package that we know that they're going to look at it in 5 minutes and say, yes or no, this is something I can do. And so I think that goes a long way for, new buyers that, if they're buying a park, off of, a Glen, then great, they put the packages together and it's phenomenal. And, it's something that we can, shoot over to our lenders and get a quick synopsis of, get a quick feedback from them as well. But a lot of what we do on our end is, putting together the puzzle, putting the pieces together so that, we can get a quick answer and, usually a favorable answer from our lenders.
Yeah, it's we've talked about it before plenty of times with the audience here, is the books and records in a deal. It's critical. You
Yeah.
know, if you're a seller and your books and records are 1975 style, you're going to have a hard time getting a 2020 price, you know, period.
Absolutely.
And the banks are going to hurt you on the lend if they're even going to lend to that next buyer who may or may not already be qualified for this part, but your books and records might be holding them back. And you know, guys like me and broker teams like me, we'll do our best to package what we can to give you something that's, you know, digestible. And, you know, if it's a direct purchase and they go to you, a lot of times the mortgage brokers will help underwrite it in a way that makes sense. But sometimes when the books and records are bad, it means it's a no-go period with the financing, or you get stuck with going to some bridge lenders and things like that. So jumping down the line a little bit now, let's say we have this 1975 style and we have to go find alternative ways to finance this thing past agency and past community banks. What other alternatives are there?
Yeah, so there are a number of private lenders out there that have recently, historically they've been on the higher rate side. They've actually come down and kind of bridged the gap a little bit from where banks were and where, we'll call it bridge or hard money lenders were in the past. So they are a good option. Their rates are a little bit higher, but it's one of those things where you may have to stomach it just to get your first park under your belt and just, gain that experience. So there's a number of private lenders out there that are working on trying to get more educated in this space and that are actually, aggressive in this space in the sense that they will get a little bit skinnier on their pricing because they know that for most of these parks, if they're run, as is and run well, they're pretty much cash cows, from a cash flow and lender perspective. There's very little maintenance involved, especially if they're only a lot of tenant-owned homes. So it's something where they feel like they're putting their money to good use and they're not going to have any headaches later on. So they'll get a little bit skinnier.
Yeah.
I'll just touch on one other thing. It doesn't really help me out at all, but what we see a lot of times for first-time park buyers is seller financing.
Right.
Seller financing, it sucks for us because we don't get the loan, but it honestly, sometimes if you're not being taken advantage of and you're getting, fairly good rates and structures and terms and amortizations, that's usually, probably I would say one of the top 2-3 options that we see that our, first-time park buyers are getting into. That, if you have a seller that's willing to take, seller finance, take some paper, then that's a good avenue because it gets your feet wet. And while you don't get feet wet in the the financing arena, you'll at least have the experience and the ownership of owning and operating the park. You have a little bit of a track record. Then when you go out for your financing with a bank, you'll be able to demonstrate that you
a little bit easier.
A little bit easier, correct? Yeah.
Yeah. There's some caveats though with that, guys. The seller finance deals, especially when there's not a broker involved, oftentimes only makes sense to the buyer and the seller. And that is not necessarily the best position to be purchasing a park in because it's going to make possibly your cash flow and your exit a little bit harder to do. Because, oftentimes we see sellers that want something like, maybe only 10% down, but then they're going to ask for a 10% interest rate or something like that. And it's going to make life kind of hard for you to ever function on a different format for a while, especially on these value add parks. And keep in mind, most sellers in this market right now are not going to be competitive with what a bank can finance these parks for. Sometimes if it's a real quality deal, it's sub 3%. If it's a community bank deal, oftentimes, and correct me if I'm wrong,
you're right,
around 4.5%, 5% with these community banks.
Yeah.
But the sellers, they often don't want to take 5% or 4%. So, you're going to have to really beef up your price or get him to come down on his price, should I say, to really make those numbers work often, to have the cash flows that you're looking for. So I always would still, strongly see if you can go get financing before you go and ask the seller to finance it. Yeah, it might be easier, but you might not really get the best possible deal. And if you're an owner, I would really try and get your parks teed up for financing before you're, taking this out to market and find out it's unfinanceable, whether you're using a broker or not. And on that note, there is some caveats with these financings, and we'll get into the tidbits of what rates are now and how things look. But typically, most banks are going to look for right now about 30% down, 25, 30, 35% down.
Yeah.
And, a seller might want a lot more down, to make sure you got real skin in the game. So again, it might it might not be the best choice to go with the seller financing. There are some other loans out there as well, as you mentioned. So we talked a little bit about agency, we talked about community banks, we talked a little bit about bridge lenders, and then some of the hard money lenders in between the bridge and the community banks. And those are all pretty great options. I've actually done deals with every one of those categories multiple times, and they all fit their purpose. And in most cases, at least in today's market, it seems that those often are still a better overall package than the seller financing that we're seeing anyways, because it almost squeezes the life out of you with the seller financing stuff that's out there nowadays.
Yeah,
Sometimes it's great, but not too often. Now, with park-owned homes coming into the equation more and more, as we're seeing people finally revitalize their parks and buying new parks and seeing the manufacturers finally get to a high level of production, how has that kind of changed the face of financing with a lot of the parks that you guys are seeing?
Yeah, no, that's a good point. So the ratio of park-owned homes to tenant-owned homes is very important when we're sizing up our deals, and also that really tells us and navigates us to which type of lender would be a good fit for that deal. So for agency execution, on the park-owned homes, they want you to be under a certain threshold, and it's usually about 30 to 35% of having park-owned homes. Anything above that, it's just not going to be a fit for them. We have specific lenders that, and talking specifically to the community banks, that will underwrite the home income, they'll underwrite the pad income, even if it's 100% park-owned home property. So there are, what I've been seeing lately is if there's a nice majority of park-owned homes, it's great. Like Glenn mentioned, it's revitalizing the park, it's bringing back to newer homes. The financing gets a little bit more shrunken down and limited in terms of, who you can go to for that type of financing. But there's, 4 or 5 specific lenders that are targeting those types of properties. And they are, pros in that, and they understand the nuances of the home values and park owners wanting to sell them off, and they understand the back office, when they take the liens, when they close on the property, and then they take liens, and then you want to go sell it and getting the releases on the liens. They understand that completely, and a lot of. I'm sorry?
But there's only 4 or 5, right? There's not a lot.
There's not a lot. There's not a lot. It's definitely challenging. What I'm seeing is there are more and more community banks that are getting, an open mind to it, but a lot of them just don't want to be dealing with, the home aspect. They want to just lend to, the collateral itself. Another nice thing is that, there are lenders that will lend just on the lot rental income, community banks specifically. And, if there's not a huge majority of park-owned homes, a lot of the times the cash flow actually works. It can support a loan just by using, the pad rental income. So, from an owner's perspective, it's actually a little bit better because the lenders aren't involved. They don't take title on the homes. They don't get involved when you sell it off. So mechanically and operationally on the back end, it's a lot easier. And what we're seeing is that, because rates have come down and, the amortizations, we get 25 or 30-year amortizations, the cash flow actually can be supported when you just underwrite the lot rental income on a lot of these parks. So that opens up a whole nother avenue of lenders that can do those types of deals.
And there's a critical metric that almost all these banks use. It's called a debt coverage ratio, or DCR. And for the guy out there that's never heard that terminology, can you explain that to them, why that's so critical?
Yeah, absolutely. So the banks use their own underwriting for analyzing and getting comfortable with the loan. Traditionally, the debt service ratio that they like to see is 1.25 times. So basically what that means is that at the end of the day, the cash flow of the park, the net operating income, has to be 1.25 times what your annual payments would be, because they want to see that the park has sufficient cash flow, that you're not spending every last dollar that you're making to go into pay your mortgage. They want to see that there's a little bit of a buffer that the park is making above and beyond, what can be supported by making your monthly payments on the loan. So that's and there's
go ahead.
Yeah, no, I was just saying, and that's not set in stone, the 125. That's, what a standard underwriting benchmark would be. There are ways where you can manipulate that and negotiate that, but as a baseline, and a lot of these parks, it's very rare, unless the buyer is not buying a good deal, it's very rare that the debt service and the cash flow are very tight, that you can't make a deal work. A lot of the times there's plenty of cash flow in these parks to support the debt service payments. We're seeing them probably about 1.5 times. So there's
Nice.
a lot of cushion there. And I heard you mention the bridge lenders. So on those types of deals, yeah, you're not going to be cash flowing day one to be able to support those payments. So there's two different types of lenders on the bridge side. There are lenders that need a 1.0 debt service going in, so they'll need a little bit of a cash flow, but not as much as traditional banks would need. And then there are bridge lenders that won't need any cash flow and or very little cash flow, even well below the 1.0. What they'll do is they'll build in an interest reserve into your loan structure, which means that even though the property can't support the monthly payments, at closing they've already allocated in their funds an amount that they know for, let's just say it's a 12-month loan for the bridge financing. They'll hold back 12 months of principal and interest in a reserve account, and they'll make the monthly payments from there. So they're not worried about the cash flow of the park being able to support the loan, because either there is no cash flow or there's very little cash flow. Right. What they'll do is they'll structure in an interest reserve to get those payments from the park.
Makes sense. Makes sense. And let's jump gears just almost entirely here and talk kind of about the differences between recourse and non-recourse, and why really most recourse is still actually, most non-recourse is still actually kind of recourse loans with the bad boy carve-outs, and what those mean.
Yeah, absolutely. So, most of the, there's two types of financing, like Glenn mentioned. There's recourse and non-recourse lending. Most of the community banks, if you're doing leverages of 70, 75, maybe even 80% leverage, those are recourse loans through and through. To get a, community bank, regional bank, credit union to do a non-recourse loan, it's got, we're probably seeing those in the 60% range and under. So the lower the leverage, the higher chance you have of getting a non-recourse loan. On the agency side, Fannie Mae, Freddie Mac, and CMBS loans, those are non-recourse. It's non-recourse to the borrower with the provision that they do sign on the bad boy carve-out. So bad boy carve-outs are basically, in the event of fraud, in the event of mismanagement, in the event of, putting the property in a bad position with the knowingly doing it, that's when the recourse will kick in. But for the most part, if you're operating your park in a normal manner, and let's just say for whatever reason the market collapses and you can't get anybody to rent your spaces, but you're doing everything you can to manage those parks and operate those parks, technically you just hand back the keys, and that's really where the non-recourse language comes in and is helpful. But it's if you go and light a fire to the park and all of a sudden try to claim that I didn't know what happened. Yeah. That's when that's when
you're going to be on the hook.
You're definitely going to be on the hook. That's really why it's called the bad boy carve-outs. It's basically you are intentionally doing something wrong to jeopardize the profitability of your park.
And why? And just for clarity, why is non-recourse so preferred, especially from people coming over from other real estate verticals that, just finally getting into this? I'm only going to take a non-recourse deal that's Fannie financeable. Why is that, what people are kind of looking for on your end? Is it just because of inexperience and it's a whole new world, or is it because there's some fundamental fail-safe in there with having the non-recourse that makes everybody feel a little bit easier, even if their down payment's a little bit heavier?
Yeah, that's a good question. And I think, from what I hear and just talking to some of the clients that we work with and just in general in the market, I think there's two reasons. One is peace of mind. Why would I sign recourse if I don't have to? If I could get a non-recourse loan, I'd be able to sleep a little bit better at night. I actually hear this a lot from lenders, and it's something that we try to tell our borrowers that, especially early on, if you don't believe in the project, you don't believe in the park, and you're not willing to put your name behind it, that's, it's a little bit of a red flag for the lender. So non-recourse, when you're getting to an agency loan, Fannie and Freddie, that's the norm. So if your park could qualify and you could qualify, absolutely, why not? Why wouldn't you do a non-recourse?
Sure.
If you're looking specifically for a recourse loan in any other or non-recourse loan in any other avenue, it gives the lenders a little bit of a red flag and say, well, if you don't believe in the project, why should we lend money to you?
Yeah.
So
because the banks are thinking maybe you're going to walk away and they're going to be left hanging on to it, and that's not exactly what the bank's trying to do anymore.
Exactly. They want you to be comfortable and confident in your project and your abilities to run and operate the park, and they don't want to be park owners. They don't want to take back the park by any means. So, even if you're going through some struggles, they're out there. They're going to work with you. They're going to help you as much as they can. And if you're right out of the gate trying to get a non-recourse loan, it just gives them doesn't give them the warm and fuzzies that they're looking for.
And right now, today, with COVID and everything since March, how has lending been with finding deals for you guys during this whole process, specifically towards manufactured housing? And maybe you can talk about how hard it is now to finance some hotels or something comparatively. But we're definitely more interested into financing a park during COVID right now. And for a guy looking at buying his first or second park at $1 million, $2 million, $3 million, somewhere around there.
Yeah. Well, if this was March, April, or May, I would tell you it's impossible. I think that there was so much unknown at that time. The markets just stopped. Lenders just put a pause on everything. Whether they just jacked up their rates and said we're not lending, and if you want to take a loan, it's going to be at 6%, and deal with it. A lot of the lenders that we were working with were dealing with the PPP loans, so they were just preoccupied and couldn't really focus on new originations. Right. But things have really come back. We're not we're not where we were before. There's definitely challenges in doing loans today that we've never faced because of COVID. But what I would say from a mobile home park perspective, it's actually one of the property or one of the asset classes we've seen that throughout our clients' portfolios, throughout the loans we're looking at, really have not been affected. I mean, when you think about it, right. Lot rentals are $250, $350, $450 a month. If the tenants are having trouble paying that lot rental income, we have bigger problems as a country as a whole. So what we've seen actually is in the mobile home park space, it's been a nice breath of fresh air from a lending perspective on what you're able to get done from a lender's perspective. They are willing and they want to do these loans because they see across the board, they see across the portfolios, the collections are good. There may be a little bit of dip here and there, but it's nowhere near what we're seeing with hotels, like you mentioned, where occupancies are at 20%, or some of these multifamily deals where the occupancy may be at 95+%, but their collections are at 80%. And right. they're really struggling. So what we've seen from the mobile home parks, the occupancy is strong, the collections have been strong. It's really recession-proof, COVID-proof, to a certain degree. Obviously, everyone has.
We've almost seen a flight to safety, not just with investors coming to our class, but with lenders opening their doors wider to this class and allocating more of their funds to this asset category as compared to their other asset categories. And that's testament to this industry. I mean, that speaks volumes. I would suggest, because during the recession, the Great Recession 10 years ago, lending was still just a nightmare to get done, even in MH parks, and we did great during the recession. And now with COVID, it seems like, hey, we're no longer that last vertical they want to deal with. Now we're one of the first verticals they want to deal with, because they understand that, hey, the metrics are good, the economy for our industry is good, and there's not a lot of gray horizon up there. We kind of actually see that things are still looking very positive comparatively. And when people start being able to not afford a $250 rent, you're right, we got bigger problems in this country.
Absolutely.
So before we wrap up here, just a couple of quick little things here. One thing that's become more prevalent now in this last few months, at least in my career of 20 years of doing this, in this last few months, is interest only. We're seeing more and more interest only come, at least on the loans that I'm, getting done with my clients, and sometimes even up to 10 years interest only. Can you explain a little bit about what interest only is and why that's such a good deal, especially for these thin, 1.25 DCR type of deals?
Yeah, absolutely. And we're seeing that as well. So whether you're dealing with, an agency lender, or even a lot of the community banks, you're able to get a portion of interest only. And the reason why the lenders do it, and they a lot of the times from a community bank, if you're asking for interest only, they'll want to know why you want it. Meaning, are you doing renovations to the park? Are you spending some of your own capital to invest in the park to make it better? And therefore, you need a little bit of relief on your principal and interest payments. But basically, what it does is when you have an interest-only loan, is your actual monthly payments are a lot less. So it helps you with your cash flow. Especially if you're just buying a park and you're not sure what the books will look like, until you actually take over. You do want to, if you have a CapEx plan, you want to do paving on the roads, you want to do some landscaping. If you're investing your own capital, it goes a long way that it'll help you in your cash flow of the park because your monthly payments will be less. Glenn mentioned that, sorry, the agency lenders, the Fannie and Freddie, you can, depending on what leverage you take, you can get full-term interest only, which helps you a lot with your cash flow in the park, especially, if you're looking to exit the park in a couple of years. So, you don't pay down the principal, but you end up, allowing a lot more cash flow to come into you from a park perspective. So, across the board, we are definitely seeing the interest-only requests increase, and we're also seeing the lending community be more open-minded to it than I think we've seen in the past. And predominantly, from a bank perspective, you have to have a little bit of a reason. They'll give you maybe 6 to 12 months for no reason, just because you asked for it. Some of them will give you up to 12 months if you have a real, game plan to turn around the park and you're investing your own cash flow. And then the agency lenders, depending on the right leverage that you're taking, they're not going to give you a full leveraged, 80% financing with a 10-year IO. But if you're willing to put in more capital of your own, 65% leverage, then you could get the full term IO, which will really help you with the cash flow of the park.
Yeah. It makes the deal just scream all that louder.
Absolutely.
So final question I got to ask, and you tell me you don't know, it's fine. Where do you see MH lending kind of going over the next 12 and 24 months with the Fed saying they're not really looking at raising rates?
Yeah, I think it's going to be extremely strong for that reason specifically. The rates, I'm not an economist. I'm not sure where the rates are going to go, but from what we're hearing, rates are going to stay pretty much flat where they are right now. And I think as the lenders, take a really hard look at their portfolio and see what their exposure is, they're going to really see that of all the deals in their pipeline and in their portfolio that, maybe have taken a hit during this, crazy time that we're living in, they're going to see that the MH space has really not been affected. And, the collections are strong. People are able to make their payments. People, borrowers have not come back for payment relief or payment abatement. It's been really strong in the asset class. I'll tell you one thing on the agency side, what they implemented, and this is not necessarily specific to mobile home parks. This is across the board, multifamily as well. They implemented a principal and interest reserve. When COVID started in March and April, this was predominantly geared at multifamily. So they implemented, holding back a closing reserve for principal and interest because they were anticipating collections to be down. It's been, affected also into the MHP space, which has not been affected from a cash flow perspective. So I think, probably, January, February time, if things, calm down a little bit, we get the vaccine out in the market, I think, in the population, then I think those reserves are going to go away, and it's going to make it for a much stronger deal all in all, and much more appetizing for your numbers.
And that's not a left or right issue. That's not a Repubs versus Dems issue. That's just how this industry is going, regardless of who's in charge. As long as we, keep showing just how bright our industry is, I think we got a great future here for investors and lenders and everybody playing ball with us.
Yeah.
So Barry, thanks so much for all of this. It's been real informative. Let me turn it back over to Gavin here and see if he's got any questions for us.
Yeah, sure, no problem, guys. Look, as you know, Glenn, every week when you speak, I always make notes. I'm still relatively new to the industry, so I guess the questions I ask is always pretty good ones, or the pointers I pick up. So, Glenn, I would just touch base with a couple of things that I picked up. So, hold on. Okay. Ideally, the first thing that you mentioned when people are looking for finance in the MH will they need to have at least 2 years experience in the industry to qualify, for example, for like a Freddie Mae or a Fannie Mae loan, as you call it. And I think that's a lot of things that a lot of people don't realize entering into this. They've gone to a weekend course or a training course. The speaker sells them this great, wonderful thing that they could do. And then they come back and then they realize, holy shit, I actually need to have 2 years experience.
Yeah, they get disappointed a lot. They get and we didn't even get into kind of the makeup of, once you're finally got the experience for Fannie Mae, what their actual requirements are. Their box is about this big.
Yeah.
And it's hard to get a deal done with them until you've gotten deals done with them, and then it becomes tremendously easier.
Yeah.
Even if it doesn't quite fit in their little box. But with the segments from Fannie to Freddie, there's differences. From Fannie and Freddie to CMBS, there's differences, and then all the way down from hard lenders to bridge lenders. And we're even seeing mezz and different types of lenders coming into the space now too, which is it's pretty exciting. But audience, the first thing you need to know is you got to get yourself in position for this kind of loan, and you have to accept the fact that the first couple deals you do are probably going to be community bank type of deals, which are pretty easy to qualify for. But you still got to get your personal books and records, teed up and ready to go. Make sure your cash and your experience that you can explain to them is there. And then the sellers that are listening, your park is only worth as much as the spread as we can create between the interest rate and your cap rate. Okay. So you have to get your parks, books, and orders in place. You have to get everything teed up so the buyer who's going to give you this top dollar can actually get it financed. Otherwise, if we can't create enough spread, then your price is going to have to come down. And that's just the end of the day with this stuff.
Yeah. And I think one of the most interesting things that Barry mentioned is don't do a 1975 style paperwork, which, I mean, in the background, I was laughing my head. I don't think you guys probably heard me. But, I mean, anybody would think in the year 2020, nobody's doing this. But from what I presume, people are doing it. So
many people. Yeah. We get screenshots of handwritten books and records. I can't tell you how often. I just underwrote a deal. It was a lady's handwriting. She wrote out the rent roll on paper, and then she wrote out her P&L with her 5 expenses, and took a screenshot and texted it to us and said, here's my books and records. It's very difficult to get that deal financed.
I'm sure it will be. So also be careful of the seller finance options. It might look good at the start, but it's probably not as it seems on the thing. You want to check the numbers outside to make sure that the deal that the seller is giving you is a good enough deal going forward.
Especially if it's short term. Like my first park that I bought the seller's like, hey, I'll finance it, for you. You give me 50% down and I'll finance it for a year or two. By the time we got done discussing it, it was 50% down and for 1 year. And I was like, oh, that should be fine. I've done this 100 times with apartments and things. And when I went to go get financed, it was hard. I had to come completely out of pocket and then go and get a bank to refinance me out a year after I finally had 2 years of books and records. And you don't want to find yourself in that position because, especially on your first deal, it about wiped me out having to come that much out of pocket.
Yeah.
So it's, things you want to make sure they have to make sense to more than just you and the seller, because there's a downline that you have to consider once you actually own that property, assuming you're one day trying to sell it or one day trying to get permanent dent on it. If the seller's giving you a 30-year mortgage, hey, great, take it, especially if it's under 5%, take it. But most of the time, the seller's not going to do that for you. Most of the time.
Yeah. The next thing I picked up on was the DSR, the debt service ratio. So ideally, in an ideal, will be 1.25%.
That's the minimum. Yeah,
for the buffer.
The minimum.
Yeah, because then it makes the loan look a lot more secure to the lender, and it's less risk. It's all about risk. How risk adverse, the lenders would be. So that's something I picked up as well. Most community banks will do recourse loans. It's very good to understand the difference between a recourse and a non-recourse loans. Although lately, everybody with COVID and everything, I can imagine they're probably doing the recourse loans. I guess unless you have, what I picked up is unless you have experience, you've done a few of these before, our lender isn't going to give you a non-recourse loan. And usually it brings up a lot of red flags for a lender if somebody wants to have that. It means that you have no meat in the game.
Right. The experienced guys are getting great debt right now with Fannie, especially if the park is a Fannie type of park. They're getting great debt. Sub 3%, 25% down. 25-year AMs and 5 years IO, 3 years IO, something like that, pretty regularly. But that's a small portion of the people that are trying to buy parks right now.
Yeah, that's correct. And the last thing that I want to bring up is about the interest-only rates that you guys talked about. Again, probably for the more experienced people who's done it multiple times and have a track record, not for the first person going in, unless you have something really, credible that you want to put down, 20 or 25% of your own money. That would make it more attractive to a lender.
And if I understood Barry correctly, if you have a real action plan, hey, I'm repaving this park, it's going to cost me $200,000. Hey, I'm putting in all new meters, I'm doing this, I'm doing that. Here's what I'm coming out of pocket to do. Can you help me offset some of my first couple of years? That would be beneficial. Then you're putting more skin in the game. The banks are going to like that. You'll have a better opportunity. Is that understood?
Yeah,
correct, Barry?
Absolutely. That's correct. I mean, you may be able to get 3 to 6 months of interest only just because, but if you're looking for longer term interest only, maybe a year or 2 years, the more the better the game plan for what you're investing into the park and what you're doing to improve it and not because you just want to have better cash flow, because you're actually coming out of pocket investing in the park. That goes a long way in getting longer term interest only from the community and banks and the credit unions that we work with. Absolutely.
Yeah. Okay, good. Well, thanks, Barry and Glenn, as always, for that show. I learned a lot today. In fact, I've learned a lot about some stuff I'm looking at for 2021. So this was really informative for me. Barry, it was a pleasure to speak with you from an MHP side. We had a show last week that we did on just commercial real estate finance, which kind of really brings the two pieces together nicely for us here at GCRE. So, I mean, in closing, Barry, do you have any comments that you'd like to leave with the audience?
Well, I appreciate the opportunity to speak with you guys, and more than happy to have conversations, or if you have any questions you want to run by Glenn or myself, I'm more than happy to get on a call or shoot a question over. We're in the knowledge business, and the more knowledge I can give over from where I sit in the transaction side, I'm more than happy to do whatever I can for you guys.
Awesome.
Okay, sure. And how would the audience get in touch with you, Barry, if they were interested?
Yeah, I can. My email is bdollman@easternunion.com. My cell phone, if you guys want to call me, 646-671-3633. And I'm more than happy to help you guys out wherever I can.
And your guys' website?
easternunion.com.
Perfect. Nice and easy.
Yep.
Thanks,
very
Barry.
easy.
Thank you very much.
Glenn. Glenn, any closing remarks from you?
I'm just very grateful Barry joined me on here. You can't even imagine how busy that guy is. So, my relationship with my team and Barry's team has gotten very strong over this last year. We've been doing a lot with each other, and we continue to feed each other's pipelines, which is fantastic. And anybody that's listening, if you need a real mortgage broker who understands this industry, Barry's the guy. You want to give these guys a call, whether it's him or one of his guys on his team. It's just like my team. We're all kind of comprehensive, and we want to make sure everybody's getting treated well and getting to the finish lines.
Yep.
Okay, great. All right, guys. Well, thank you again, as always, for doing this show. And we look forward to having you guys next week. Take care. And
Thank you very much. Appreciate it.
Take care. Bye.
Thanks, guys.